Right, Module 1, the basics of bridging finance. So this is what is bridging finance. So essentially bridging finance is a short-term property finance solution for properties that otherwise would be unmortgageable. So if you're looking at doing refurbs, for example, where they're unmortgageable through standard buy-to-let methods, then you could do that where there's no kitchen, no bathroom, for example. If you're buying something pre-planning, for example, so it could be land, could be a commercial building, anything like that, then that's where you could use bridging as well. If you're purchasing below market value, for example, you may decide to use bridging for that, because within bridging finance, some bridging lenders will allow you to lend against market value rather than purchase price. So that's where you could also use that as well. And essentially as a summary of bridging finance, you would use it where essentially you need to bridge the point between A and B. So if there's something you're looking to achieve by point B, then essentially you bring bridging finance in to do that. So you would choose to use it where speed matters, where there's something, like we said, unmortgageable that you couldn't use standard finance for, or really if you were just trying to do something a bit more creative, where a buy-to-let lender is just going to ask too many questions. And poor credit as well is a good one. So any bankruptcy, CCJs, maybe poor affordability, those kind of things, that's where you could look to use bridging finance as well. So essentially that's the scenarios where bridging finance would come in handy. So when it comes to the cost of bridging finance, there are a number of things to factor in. A lot of people believe bridging finance is incredibly expensive and that it's not really fit for where they want to go. Now, that may be the case for some people. However, bridging finance really is the cost of doing business. So there has to be an increased cost because there's an increased risk, unmortgageable properties, bad credit, properties that are in need of dire refurb, for example, maybe buying below market value. So there's more of a risk associated to properties that you're purchasing with bridging finance. So naturally, off the back of that, it's going to be more expensive finance to raise. So in terms of your interest rates, you're looking anywhere from probably 0.5, maybe 0.6% a month, all the way up to 1.2% a month. Case by case, depends on your credit profile, the state of the deal, all these other factors that come into it. But as a rule of thumb, the interest rate, you probably want to try and keep it around 10% per annum. In terms of your arrangement fees, across the board it's pretty much the same. There's always going to be a 2% arrangement fee and either a 0 to a 1% exit fee. That exit fee is really important because not many people pick it up when they're looking at terms, and terms is something that we'll go through a bit later on, but when you're looking at it, you need to understand whether there is an exit fee, when the exit fee is payable, when it's going to be charged, etc., how you're going to pay for it, is it going to come out of sale proceeds? So that's something to always keep in mind when you're looking through terms as well. In terms of the arrangement fees, normally these are all added onto the loan or deducted from the gross loan. So again, you need to be aware of what's going to come out of the terms and leave you with a net day one facility. So again, we'll go through the terms a bit later in a bit more detail, but these are things to start thinking about when you see a set of bridging finance terms. Is when are the arrangement fees due, how are they paid, when are the exit fees due, how are they paid, and how much they're going to be, and what they're based off as well. Because if it's 2% off of the gross loan, it's much higher than 2% of the net loan. So it's worth keeping that in mind as well. And with the interest rates as well, it's always need to be very aware of whether it's retained or rolled as well. So if it's rolled, essentially you're paying interest on what you've actually borrowed, whereas if it's retained, you're essentially paying interest on the gross facility, which means you're paying interest twice, essentially. So you're essentially paying compounded interest. So because they retain the interest out of the gross facility, but you're paying interest on the gross facility, you end up essentially paying it twice. It can be a bit more expensive than using rolled interest. So again, just keep that in mind when you're looking at the terms as well. You're also going to have legal fees to pay, which on a bridging loan are going to be substantially more than your standard buy-to-let. Standard buy-to-let, the legal process is much simpler. There's just a standard set of inquiries that you would have if you were buying any normal residential property, whereas the legals on a bridging loan tend to be more commercially based inquiries, so they may be referenced as CPSE, which is Commercial Property Standard Inquiries, so they may well put a shorter form of CPSEs in, which you'll obviously have to deal with your solicitor. So legal fees can be, rather than £500-600 on a standard purchase, or even £1,000 on a standard purchase, maybe £2,000-3,000. In terms of the valuation as well, because bridging finance is more creative and because you're using a more creative strategy, you may find that the valuation needs to be a red book valuation rather than a one-page standard form valuation. So standard valuation, again, maybe £500-600, but a valuation for a bridging loan is going to be potentially £1,000. So there are all of these costs associated with bridging finance which you need to look at and make sure you understand when you're going for bridging finance. And obviously we'll go through terms later, like I said, which we can kind of detail those out. But again, things like application fees, they could potentially be hidden fees that you need to keep in mind as well. And there may be other administration fees or things like that which you'll need to keep an eye out on the terms for. And they're the things that can really start to make bridging finance a little bit too expensive to work with. But overall, they're the costs that you need to keep in mind when looking at bridging finance. Refurbs and auctions. So essentially, when it comes to bridging finance, these are the two biggest uses of bridging finance. So when it comes to refurbs, the reason why you're using bridging finance is because normally the property is unmortgageable, or you're looking to add value and then refinance, or just in general you just need to move a bit quicker than you normally would. Similarly with auctions as well, the reason you're using bridging finance is because there's a 28-day deadline that you've got to meet, and buy to let, just with the best will in the world, is never going to happen in 28 days. So that's where bridging finance comes in on an auction purchase. One thing with auctions to bear in mind is that obviously they're forever changing things with auctions, so always check whether you've got 28 days or 56 days. A lot of the auctions that we've been seeing recently are now pushing to 56 days. Obviously if you've got those 8 weeks rather than 4 weeks, you could potentially go with a buy-to-let rather than a bridge, so you could in effect save yourself quite a bit of money depending on the state of the property, etc. Worth keeping that in mind. When it comes to the refurb, the bridging company are essentially going to be lending you money based on what it's worth now, with a view to you adding value and then moving on to a buy-to-let in order to refinance all your money out. When it comes to a bridge on refurb, one thing to bear in mind is if you take a bridging facility, they're not going to lend you anything towards the works. So you have to be very aware that if you take a bridging facility for a refurb, you're going to be responsible for all the build costs and you're going to be responsible for taking it from a shell to a fully finished property. With auctions as well, one thing to bear in mind as well is that when you go for your bridging finance, they'll give you an agreement in principle, which is specific to each property. They don't give you you can borrow up to X amount, it's always specific to the property. But one thing is that AIP is not an offer of finance. And in fact, actually the offer of finance doesn't happen until the valuation's taken place and the legals are fairly well advanced. So one thing to bear in mind is if you're taking bridging finance for an auction purchase, is that there may be a risk that it falls through. So keep that in mind and obviously have a backup just in case, whether it be a second bridging lender or whether it be cash. But you need to keep in mind that there is always that risk that could fall through. But that's where bridging finance is the most effective, is refurbs and auctions.
So the next video in the module is talking about the pre-application stage. So this is the stage before you submit everything over to the lender and kind of all of the stages that take place, I guess, before that happens. So the first thing you do is you gather all of the information about the deal. You'll gather purchase price, if there's any refurb to take place, essentially the bones of that deal. You'll submit it over to your broker. Your broker then has a look through it, comes out with any questions. Those questions are fairly standard. How long do you want the loan for? How much are you looking to borrow? What's your background? What's the plan for the project moving forward, etc. And with that, they then build up a 1-2 page summary, which then goes over to the lenders. So what then happens is that gets sent over to the lenders. The lenders will then look through the bones of that deal. They'll come back, they might have a couple of other questions that they want you to answer. And then what then tends to happen is that essentially BDM, which is a business development manager or a salesperson from the bridging lender, will then have a look over the deal. They'll give it a once over and then issue a set of terms. That's called an AIP. So that's your agreement in principle. What we'll do in one of the later videos is we'll actually sit and we'll go through an agreement in principle and actually give you an idea of what does an agreement in principle in bridging finance actually entail, what does it mean, what do all of the different terms mean, what does all of the different monetary pieces of that jigsaw mean, and what we'll do, we'll go through that AIP hopefully in a lot more detail. So what happens, that AIP comes over, you look over it, we look over it, we then sit, we have a conversation, and at that point, once you're happy with that agreement in principle, we'll then move to full application. So in the next video, we'll talk about what the full application actually entails, but in terms of prepping for that first stage, just make sure you've got all of the numbers around the purchase, all of the numbers around if there's any refurb taking place or anything like that. And then obviously your numbers around your exit. So are you going to shift onto a buy-to-let? Are you going to obtain planning? Are you going to look to sell the property? Are you going to flip it into an auction? what's the end plan with that? Once you've prepped all of that, that's enough to put over to your broker, and then obviously your broker will put that into a 1-2 page summary, which then goes over to the lenders. So all in all, not the most intensive pre-application process, and as you'll see from the next video, the application process isn't too difficult either. So the application process when it comes to bridging finance is relatively simple in that once you've been presented with a set of terms that you are happy with, you've gone through the fees, you've gone through the interest, you're happy with your day one loan, you've negotiated the absolute life out of the set of terms, you then go into application. So what you'll be presented with normally as a rule of thumb from the lender is maybe a 5-6 page application document, things like going through your personal details, the details of the deal, maybe a bit more of a breakdown of the build cost, the GDV, etc., a bit around your assets and liabilities, and just some general information about yourself and the deal. Once you've done that, you may have to then also present a breakdown of maybe if you're doing a refurb, some of your breakdown of your refurb costs, a bit of an action plan for how you're going to take the project from start to finish, and those will be presented alongside the application. But once you've submitted all of that, what then takes place is essentially a soft credit search, if you like. So they'll have a quick look at you, the company, make sure that there's no CCJs, bankruptcies in the background, make sure that they're happy with you as a borrower. And once those checks have taken place, if anything untoward does come up, that doesn't necessarily mean that the deal is going to fall apart there. It just means that they may make a change to the interest rate. They may take a sort of view on the loan to value, etc. But what will happen is at that point, if there is anything, they'll then start to look through and basically come up with there's a CCJ here. We need to add maybe 0.1% a month onto the interest rate, for example, just to manage that risk. But once they're happy with all of that, once they've gone through the application, once they've gone through the credit checks, once they're happy with the project, etc., at that point, it will then go into valuation. So the application process as a whole actually is relatively simple. And once you've done the valuation, which we'll talk about in a bit more detail in another video, and once you've done the legals, again, which we'll talk about in a bit more detail on another video, once they're done, pretty much you're at drawdown. So the application is much less invasive and much less intense than you would normally get with a buy-to-let or a residential mortgage, for example. So all in all, that's the application process for a bridge.
Right, preparing for the valuation. So there's some key things that you need to do in order to prepare for the valuation when it comes to bridging finance if you're doing below market purchases or refurbs, for example. So the first thing you should always look to do is a valuation pack. Now, some people say that valuation packs don't work, some people say that they do. From my perspective, I would say it's always worth doing a valuation pack for a couple of reasons. So the first one is if you're bringing on a private investor, for example, you're going to be creating a pack for them to look at, for them to invest anyway. So doing that as well as a valuation pack at the same time, you can use the same information across both. So I think it's a good habit to get into, to create these packs for every single deal that you're looking at and that you're pushing forward. Because naturally when you get into the bigger deals, you're going to have investors saying, well, what have you done previously? That's when you can pull out the valuation packs that you've done before or investor packs that you've done before, and then obviously show them quickly and easily what you've done before. When it comes to managing the estate agent, this bit is key because when you're purchasing below market value, there is a tendency for the valuer to value the property at purchase price. So let's say, for example, you find something that's worth £200,000 and you offer £150,000 and you get it. There is a tendency from the valuer to go and take essentially the easy route on the deal. And they will go and they'll say, well, this property is only worth what someone's willing to pay for it. So you've offered 150, you've got it for 150, that property must be worth £150,000. When I say about managing the estate agent, you need to make sure that the estate agent doesn't tell the valuer the purchase price. There is no obligation for anyone to tell the valuer the purchase price. They're under no obligation to tell them what you've offered, etc. So from the agent's perspective, you can go to them, you can approach them, you can say, well, look, we've offered 150 on this, we're worried that the valuer is going to value it at purchase price, so don't tell him what we've offered on it and just tell them what it's listed for. So it's listed for £200,000. It's then up to the valuer for them to go out and make a decision, well, what is this actually truly worth? And that's when you get a legitimate valuation rather than a easy route valuation, which is just saying, well, this is what you paid for it, this is what it's worth. So that's where you need to manage the agent, the vendor, just to make sure that no one goes and tells the value of the purchase price. And we work with the lender to ensure that the lender doesn't tell them what the purchase price is, because obviously what we don't want to do is for the deal to fall down because you found a below market value but then actually it turns out that you're buying it for just what the valuer says it's worth. So we try and manage all these people throughout the process to ensure that no one tells the valuer what the purchase price is. When it comes to the refurb, when you're preparing your valuation pack, you need to ensure that you've got a breakdown of the build costs, maybe some plans of what it is now versus what it's going to be when it's finished, some CGIs, because when the valuer goes out to begin with, they're not going to be able to visualise, like you are, what that property is going to look like when it's finished. You know what you want it to look like when it's finished, but trying to portray that to the valuer is very difficult. So keeping it simple for them is probably the best way to proceed. So making sure that you've got a valuation pack that's got before and after CGIs, because you're not obviously going to have pictures of after until after it's finished, but making sure you've got the before photos versus the CGI is always a good place. A breakdown of the build costs as well, because they'll want to understand how much you're spending on it. And then just some general information about some comparables that you've seen nearby. The comparables, 9 times out of 10, they're going to completely ignore them and go and do their own thing anyway. But at least if you've got it in there, you've got something which, when you present the valuation pack, just gives it a bit of background and a bit of evidence as to how you've arrived at the figures you've arrived at. But that's everything that you should do to prep for evaluation. So the offer process and the legal process, this is where you're going to need to be on your A game. So you're going to need to be involved in every step of this. You're going to be needing to push your solicitor forward. You're going to be needing to put pressure on the broker, the lender, everyone to ensure that things are moving forward as quickly as possible, because you're going to be under immense pressure from the auction house or the estate agent or the vendor to complete this as quickly as possible. So when it comes to the legals, they're going to ask you all the standard inquiries. They're going to want all the standard searches, so your local search, your water drainage search. They may want mining searches, depending on where you are. That tends to be more in the north. Radon searches, all of these random searches that you normally get whenever you purchase a property. They're not going to want anything outside of the norm. Depending on the area you are, you might have chancel searches, which are a very rare one, but that essentially is a search to check whether there is a obligation for you to pay towards the local church upkeep. So that's a very random search that comes up now and again. But that shouldn't affect the lending process. But these are things that you're going to have prepared and sorted. The main majority of inquiries they're going to be asking are all of the inquiries that you would get on a standard purchase. So rights of way, deeds of covenant, going through the land registry title plans, going through the land registry title register, checking previous conveyances, checking essentially the history of the property, checking for any planning permissions that may be going in locally, anything to do with your water, your drainage, anything like that. Just generally the state of the property legally. So all the normal stuff that you would have. Before you get to the legal process, there's going to be an offer that's issued to you from the lender. So they will issue a full offer at the point that the valuation is back, maybe if you've had to have an asset manager go out or something like that. But this full offer will essentially detail down everything in its final format of what you're going to spend out in terms of interest, arrangement fees, exit fees, what you're going to get net day one, any application fees, commitment fees, all of these things. So that offer is the bit that you then need to work off when working with the lawyers in terms of ensuring that you understand fully your obligations under that offer. What will then happen is once you're in the legal process, that offer will then become essentially a deed of charge. So they will then essentially convert it into a charge. At that point, they're the documents that you will sign, and that is what then puts the legal charge on your property, the first charge that's then registered at the land registry and company's house. So just make sure when you're going through the legal process that you're using, and this is probably the key bit, a solicitor that understands bridging finance, development finance, refurb finance, and making sure that they understand how that process works. Because reading through a buy-to-let mortgage as a solicitor is much different to reading through a bridging document, because they're completely different. It's chalk and cheese. So they need to understand what they're going through, and they need to understand how to portray that across to you so that you know when you sign those documents what you're signing up to and essentially what your exposure is to the lender. As part of the legal process as well, they're also going to get you to sign a personal guarantee, which is something that we will cover in later videos, but that is key, the personal guarantee. And they'll also get you to sign a debenture over the limited company as well, something else that we'll cover in a later video. But they are two key documents that you will need to sign. You will also need to go and get independent legal advice as well. So that is another expense during the legal process. So the solicitor that is going through your documentation, going through the legal process, can't be the solicitor that sits with you when you sign the legal charge. or the PG or the debenture. So what you have to do is you then have to go and instruct a second solicitor to sit and do the independent legal advice with you. And they will just run through the offer with you. They'll explain it all to you and say, right, do you understand that you owe X amount of money? Do you understand that your personal guarantee is X amount? Do you understand that there's a debenture over the legal entity, the limited company? And they will just run through all of that with you. ILA, independent legal advice, normally costs a few £100. So again, that's another cost that you need to build in within the legal process as well. But all in all, it's a relatively simple offer and legal process, but that's how it should all work. So a quick summary of the pros of bridging finance. So the first one and the biggest one is that it's quick, and when it comes to auctions, it's pretty much the only finance that you can use to get through within the 28 days. So speed is a massive thing when it comes to bridging finance, and in some circumstances can actually be quicker than going and trying to get cash if it's tied into ISAs or into stocks and shares accounts and things like that. It can actually be quicker to pull it through a bridging loan. The other thing is that it's one of the easiest finance products to raise. So no bank statements, no credit profiles. It's asset-based finance. As long as the deal stacks, you don't really come into it. The application process is much quicker. The turnaround times of talking to the lenders is very, very quick. So with a buy-to-let, for example, as a broker, we get an application form in, we send it to the lender. It takes 7 days for them to turn it around. Whereas when it comes to bridging finance, they turn it around within a couple of hours. So it can be really, really easy to use. And again, it sort of jumps onto that speed element of it as well. When it comes to the uses, obviously there's multiple uses for bridging finance. So auctions, refurbs, below market value, title splitting, which is something that we will cover in later videos alongside below market value. But just in general, it's a very versatile, very easy product to use. So those are just a quick summary of what bridging finance is good for. So a quick summary of the cons of bridging finance. So obviously it's designed to be short term. So the issue that you've got with bridging finance is that it really is just a short term solution, 6 to 9 months maximum. So you've got to be very, very quick at turning deals around and getting back out of them. So that's one of the biggest cons is that short term element of it. Obviously it's expensive. We've been through in previous videos the interest costs, the arrangement costs, the exit fees, the legal fees, the valuation fees. All of these costs add up very, very quickly. Obviously it's the cost of doing business, but bridging finance is naturally just a more expensive product because it's so much more higher on the risk profile for a lender. And the biggest one, actually I said short term was the biggest one, but actually the biggest one is if you go into default. So bridging finance is notorious for adding default interest rates, extension fees, and all of these other costs that come if you run over the term. So in later videos we'll talk about how you can avoid that and how you can sort of manage those costs. But something for you to keep in mind is bridging finance is exceptionally dangerous if you run over that 6 to 9 month term or whatever it is you end up taking. It gets very, very expensive and could even lead to repossessions and obviously blips on credit files and everything else.